This meeting is being recorded.
Folks, I think it's pretty obvious that the United States and arguably the world is heading into a recession. I think it's more important to understand what type of recession. This is not going to be a recession like the COVID or even the '09 recession where it was down and up, where everybody went in the same boat together. I think we need to start talking about and understanding what is a rolling recession, because they are very different. They might be more or less painful. They might be more steep or shallow. These are all conversations we're going to have with a 10-year Wall Street veteran, Taylor from Life Goal Investments. How you doing, buddy?
Doing great. Thanks so much for having me. I'm excited for this. This is an interesting one because I think people have to learn some lessons from history here to understand kind of emotionally how they have to set themselves up going forward as an investor.
Yeah. So one of the things that I've put out for quite a while now is I think this recession is going to be very different than the last two nasty ones that we've experienced, right? The COVID and '09, which were just everything's broken. We shut the country down, all of this. The banking system is a threat and everything goes down. It's going to be a rolling recession where it goes kind of industry by industry. I think it has already hit mortgage. It has already hit real estate. I think it's going to hit automotive next. And we're going to just
Has it hit
ripple
tech
through.
yet? Has it hit tech yet?
It's coming. I think you've seen some cracks, but I think Q1 is ouch.
Yeah.
Finance,
Yep.
Goldman Sachs, Wall Street talking about bonuses being anemic. Ouch.
Goldman
So
Sachs, they are the creme
Creme
de la creme.
Yeah, yeah. So again, let's talk about a rolling recession. A, do you agree? B, what does it mean? What should we do? Yeah.
I totally agree. You look back at 2020, and I call the COVID a 45-minute recession, right? It was induced by the government going, time out. We're done. Everyone stay at home. Yeah, get back in your basement immediately. So yeah, but no, there are much more. I think this is going to be much different going forward. This is going to be more of your traditional business cycle type recession, where 2008, if you look at that, there was an epidemic within the banking system. And I don't think that there are those absolute chinks in the armor right now where there is some systemic problem that is going to drive one particular industry to go on the brink of out of business. But I think what you have right now is a Fed induced recession. This is economics 101. At the end of the day, what we have here is an inflation rate that took off. We came out of 2020. I'll even rewind back. I won't even call 2020 a recession. So let me just rewind back to 2008. What you had here was 2009, the market cycle troughed, and then it kind of built on low cost of capital money that was able to be infused into all businesses, very accommodative Fed, very accommodative fiscal policy, et cetera. And what you have then is an economy that started to get overly hot, right? And a lot of it was fueled by what happened during COVID, by people having huge stimulus checks pumped into their economy, PPP loans, et cetera. And so you had that kind of hitting that crescendo. And what happened was inflation took off. And this is what the Fed is there for. The Fed is there to control inflation, price stability, and to control unemployment. Now, unemployment's still very low, but inflation is a massive problem. And what is the tool or tools that they have to deal with that? They have interest rates, and they have their open market committee, which means whether they're buying or selling bonds into the market. Both of them right now they're standing on the brakes, yanking rates higher, but also behind the scenes, which people aren't talking about nearly as much as they should be talking about it, is they're letting their balance sheet, their war chest of bonds that they've held, they're letting it roll off. And now it's having to be digested by the market naturally, as opposed to having that invisible hand buyer propping up the market when the Fed was infusing money into the market via buying these bonds. So now those two things have gone away. And what you're having is that, kind of inflection point at the top of the business cycle. And now we're going to go back into contraction mode. This is a natural progression of an economic cycle.
Yeah. So when I look at a rolling recession, if I were to kind of help people understand what it is and why it's different, is I think there are two things. And again, disagree with me if you do.
Yep.
I think a rolling recession, just by the very definition and how they cascade, means it's going to be a longer recession.
Yep.
Right. The average recession from memory is like 11 months or 10
Correct.
months
Yep.
or something.
Yep.
Right.
Spot on.
I think this is longer. So it might be 14, 16 months. It's longer. It's also going to be shallower because, again, recessions are made at the GDP level. Like there isn't a bigger umbrella. And when you have these little things, even real estate is something I look at every day. It's about 13% of GDP. It is in a depression. We have lost 40% of transactions. Multifamily, year on year. We did $130 billion in Q3 of 2021. We did $30 billion in Q3 of 2022.
Explain to me a little bit further what you mean by you say we did.
Transactions. There was
Gotcha.
$130 billion in transactions, consummated transactions. A buyer and seller agreed and closed.
Gotcha.
A year ago. We did 30. That's like a 72% drop. That's because, again, why is transactions important? Because all the people that are paid around it.
Yep.
Right. So again, that's going to pull
banker. Yeah, the banker, the lawyer, and then after that, the
lawyers,
furniture store. Lawyers, plural, exactly right. The furniture store, the Home Depot, the renovation, all of that. Yeah, that's why again, real estate, to your point, is 13% of the economy because all of those constituents get paid.
Yeah, so that's already there, right? And again, this will roll out. I'm already telling folks that I believe we've hit a bottom in transactions. 4.08 was the last print. I think we might go to 3.9, right? So we're close to the bottom. I'm not calling for a return. Don't hear that. But once you're at the bottom, you can start to build and people will quit and this and that. Go ahead.
Question on that. Is that a function of interest rates or mortgage rates having peaked in your opinion, or is it a function of prices having come down and stabilizing, or a combination thereof?
It's everything. I believe housing is always a payment-based system, and payments are a combination of price, rate, and wages. Also, I believe, unlike most economists out there, that the demand curve for real estate has changed, and nobody else is talking about this. If you go back and look at real estate for the last 10 years, we averaged about 6.2 million transactions. I believe for the next 2 to 3 years, it'll be 4 million. And oh, by the way, let's not forget 23% of transactions are cash. Right, first-time home
cut
buyers
by a third.
28. Yeah. So, but again, if you still have the cash buyers who aren't impacted by rates,
right?
It's not going to be the massive price drop that everybody's calling for. Again, and I'm on record many times saying, sorry, prices, and it's going to be boring. I'm not calling for a price increase at all. But yeah, so I think I think rates have peaked. I think that run up to 7.31 is the peak. I think rates average sub 6 next year. I think terminal rate for the Fed is 5. We've already talked about that. We're almost there. I think we get 2 quarter rate bumps in Q1, and then they're done, right? Feb and March. So yeah, I think housing is bottoming. I think we're in a bottoming process for housing for the next year, maybe 18 months.
For the record here, I actually think that mortgage rates will come in lower than that because I am.
Wow.
Yeah.
That would be awesome. Dude, watch out. Housing might take off.
Yeah, watch out, right? Screaming white hot again. Now, I do think, though, that mortgage rates come down more than that. And that's just a function of where I think interest rates in general are going. I don't think the Fed's going to raise as much. And I think the back end of the yield curve is going to come down with a recession.
Yeah. But again, this rolling recession, I think it's just going to be longer and shallower. It's going to feel like we're operating in mud is the best way I can kind of articulate it.
Yep. Yeah, and there are a couple times throughout history that we can look at kind of, rolling type recessions. And, this is an overused analogy, but it's overused for a reason. Like the 70s is the only time frame we can look back at. Inflation hasn't been rampant, right? Throughout our history, inflation has not been
not since 80 whatever 2 or 3 was the last time.
Right. So if you look at the 70s, which even during the 60s, you started to see that inflationary build and it wasn't dealt with appropriately, which is why the Fed is being so staunch right now on their rate hikes because they don't want to repeat the 70s. The 70s had a recession in 1970, 1973, 1979, and then again in 1981. So that is what happens if you have this start, restop, inflation take off, inflation mutes, inflation take off, inflation mutes. That's why the Fed's doing what they're doing. And then if you look at more of a kind of potentially a traditional type rolling recession, you can look at the late 90s, early 2000s. And it is painful. And when I say that, you have that .com bubble burst. I don't think that bubble exists right now. I think that there was some of that I think has been deflated this year. And those bubble
and today they're called zombie companies. Right.
Yep.
I think, I don't remember where I read this. It's like 12% of the Russell 2000 are zombies. That's not
30% of the Russell 2000.
30%.
Again, so that's small cap companies. So that's small companies. 30% of Russell 2000 does not produce profits. So they have.
So some of those will grow into their earnings, but
Correct.
some of them won't exist. Right. To your point, I think I think there were so many companies that lived off borrowed money because risk was zero.
No doubt. No doubt.
No
And
doubt.
you had just an appetite of people out there. And you look at some of the reasons behind that. A lot of that is there wasn't an alternative. So you think about, and I keep, I'm belaboring this a little bit now because over the last couple episodes I've talked about it, but like bonds are now an alternative. Bonds are now a place where people can go and go, okay, I can get 4% on a treasury, risk-free, risk-free with the advantage of not paying state and local tax on it as well. Not bad. Now I have to look at the market and say, hey, can I go out and find a better operator, a better use of my capital to get a compounded annual growth rate above 4%, because that's the bogey now. Whereas the bogey
it's
last
significantly above, because you're not going to go for 4 or 5. You're going to want 5, 6, 7. That's why I think a lot of folks, back to kind of conversation number 3 today, bonds might be the right answer, right? Hey, I got to lick my wounds. I'm not sure where to be. 4% is a hell of a lot better than negative 27. Yeah, it's certainly, if you have, always have an emergency fund, of course.
Yep.
But yeah, if you're sitting on some, you're part of that 45 billion that exited the market for tax loss harvesting last week, and probably more this week. But again, I still can't believe it. We talked about it 2 months ago. I'm going to go buy some 10-year treasuries at 4.6.
Yep. By the way, what's the best asset class historically on a relative basis in a recession? Bonds. Bonds better than cash. Cash does, flat, whatever cash is paying you at the time. But bonds annualize a positive 7.5% return looking back at recessionary years. 7.5. And when you see on the other side of it, US stock market averages about negative 18%. International stock market averages about negative 27%. Real estate averages about negative 9%. Gold averages about negative 5%. So like if I list them out in order of best to worst, because I just did it all over the place there, it goes bonds, gold, real estate, US stocks, international stocks being the worst. So again, if you're anticipating a recession coming, let's look at history as a playbook. Bonds are a place where you should be storing capital right now. And bonds also do this. So as you get appreciation in bonds during a recession, 7.5%, what does that also give you? Dry powder to buy stocks when they get absolutely blown out on the downside. Because there will be a point where the market just throws up on itself. And when it does, if you have that dry powder of something that's performed positively during that tough time, wow, isn't that a nice situation to be in? Don't you feel like Warren Buffett at that point going to Goldman Sachs in 2008?
Exactly. Well, you do a lot of great stuff on Instagram. What is your Instagram page? Because people got to follow you. And folks, if you go to his page today and follow him, send him a note saying you came from one rental at a time.
So many people have. So I'm incredibly thankful for your channel and incredibly thankful for you having me. I mean that sincerely. Yeah, follow us at Life Goal Investments. We try to make investing easier. We try to make economics easier in more layman's terms than CNBC does.
You do an amazing job. Daily stuff that really helps the average person. I appreciate you, Taylor. Have an amazing week.
You too. You're the man, Michael.